Welcome back to Ferocious Education. This is Zed. Today I'm making a different video. First of all, thank you for your 15,000 subscribers. Almost getting there. It's been an amazing journey so far, and this video is for my subscribers and people who've been asking for this one for quite a while. Here I'm making a different video. I'm talking about the market, if it's gonna crash, what to anticipate, and what's happening next. Now I'm gonna dive through things, basically what I'm seeing in the next months or so and how I'm gonna change my strategy, including some academic papers that I'm referring to today, and I'll show you them. And then I'm going to go towards charting, significantly showing where the significant channels are for the markets and where to start expecting bounces. Now, in this case here, this is not going to be a political statement or whatnot. I'm just looking at the market from a standpoint of view here, and we're just here trying to make money. So let's jump right into this one. So starting off with the US 10-year Treasury note. This one here today has hit a higher off 1.778. Now, this here is, for some people, is a mark for what inflation would be. And if it does hit 2%, a lot of people would start taking their money out because they hit that interest rates might get a little bit higher. Now, even though this is not actually a significant measure or a correlated or a direct measure towards inflation, but nonetheless, it has some correlation towards that inflation. And at 2%, the Feds are anticipating to increase the interest rate of inflation, 2% of inflation. And so that's some things that I'm kind of on top of my mind that I'm watching. You can notice even when this goes higher, the 10-year Treasury note, stocks tend to dip a little. And another thing that I want to talk about, two things actually, is the SP5 price to book value and the SP500 price to sales ratio. So the SP5 price to book ratio, and what you're looking at right now is that the current valuation is 4.30, and that's as of today, 1:37 p.m. And we're looking into a mean of 285, we're looking into a medium of 278, minimum of 178 into the housing crisis, and a maximum of 506 in the dot-com bubble. And the reason why I'm taking a look into this one here is for one main thing, is that to see, well, at some point, this one here, the dot-com bubble, taking this one as a resistance of the price over book, which a lot of people aren't taking into consideration. And the reason for this kind of practice is that I'm only trying to see, well, if the market was to quote-unquote crash, and I'm saying, you know, this market is not really currently crashing, it's still up high. Crashing would mean popping a bubble. Right now, it's more of a dip rather than anything. So what we need to understand here is, if it was to crash, how much pullback are we probably going to be seeing? And so I gone around and started this Excel sheet here, or spreadsheet, whatever you want to call it. The price over book currently is around, let's say, 4.3, which 4.30, and the mean is 285. The minimum was 178 on the housing crisis, 506 on the dot-com bubble. And I said, you know what? We're going to draw a line here around 3. We're going to say that's somewhere around the estimate. That's given significant supports and resistances previously. It was at the 3 level. And we were to see here is that if we were to go through the mean, that crash would be around 34% downwards. The minimum, something like the housing crisis, the housing crash crisis, you're probably looking around 59%. So more than half of the entire market value would disappear, evaporate. And then the maximum, and this is the upside actually, because it's currently at 506, we would jump 18% higher before meeting that significant resistance. And if we were to look into, let's say, an estimate, I went with an estimate around 3%, just throwing in a 3 price over book. We're just throwing roughly a number out there, as I mentioned. And you're seeing that would drop down somewhere around 30%. So that is where I'm seeing things might happen. But I thought, okay, price over book is cool and everything, but what about price over sale? This really signifies more of the economy strength as well at some point. And you're seeing here that the mean is 158. Currently, we're at 290. But the minimum is 0.80, which is, again, housing crisis. And then the maximum was in December 2020. And actually, the maximum is currently right now. And what you're seeing here is that this maximum is 275. Well, actually, it's 290. And so even at the maximum this more of index is tracking, we're able to see that the price over sales, at the mean, it's around a 45.5% downfall. And at a minimum, you're looking at the minimum time at the housing crisis, you're looking at a almost 2.4% downfall from where we're at. And at the maximum, quote unquote, it's a 5%. So what we're seeing is that we're at the highest levels on price over sales, even higher than the dot-com bubble. Dot-com bubble was probably around 190, or around 2. were higher than there even. So that's something that was considered a little bit offsetting for me in general. And then we need to look into a couple more things. So for instance, the fear versus greed. And we're seeing currently that things are slipping. For instance, the yield spread for junk bonds versus investment grades is shrinking. Now that's currently at extreme greed. Safe haven demand, greed. And you start seeing that it's actually retracting back to fear. And another thing I want to look at here, and this is on FinViz by the way, you can get the economic calendar very easily from the home page. Well, it's currently going to be the unemployment rate happening on March. We're expecting that 6% is going to be the unemployment rate, an improvement from a prior 6.2%. But tomorrow's ADP employment change will give us a little bit of a hint on what's going to happen on Friday. And another thing that I want to look at here is this research paper that came in out of the New England Journal of Medicine, and it's for new SARS-CoV-2 variants, clinical public health and vaccine implications. And I've read this one here, and this is one of the tables that I really want to highlight. And this is something to consider in terms of choosing and picking your plays in the next few months. And again, this is not a political thing. I'm a person who is into academics. I'm doing research, etc. So these things, when I read them, it kind of resonates with me to understand what the science are behind them. And this is a table to summarize. So if you were to look, let's say, into the Johnson & Johnson, the efficacy prevailing clinical COVID-19, you're looking at 60%, okay? Now, I don't want to look into efficacy preventing clinical COVID-19. I want to look into variants. B117 variants and 501Y.B2 variants. And what we're looking into here is that if we were to look into the Pfizer, there's a decrease. Oh, and by the way, there's the P1 variant. We're looking into a decrease by 2 times in terms of the B. I'm just going to say the first, second, and third variants, and you know what I'm referring to. The first variant is times 2 decrease. The second variant is almost 7 times decrease. And the third variant is almost, 6.5, almost 7. And the Moderna vaccine, you're looking at 1.8 times decrease in the first variant, 4.5 in the second variant, and in the third one, you're looking at almost 8.6. So that is quite significant as well. And if you were to look into AstraZeneca, you're looking into, for the third variant, a decrease by 86 times to complete immune escape, which means it's almost not even effective towards there. Now, again, this is research data that was available on March 18th. This research paper was gone out on the 24th of March, and so it's very, very recent. And this is alarming for one reason. It's not only about vaccinating the US, or vaccinating Canada, or vaccinating North America. It's vaccinating the world. Because imagine this second variant or the third variant keeps mutating. It goes further and further from us, and guess what? Before we know it, we're back into lockdowns, and we need other vaccines coming up because these vaccines that we've had are no longer as useful as we thought. Because yes, we kind of eradicated this wild COVID-19 variant, but then it comes into the other variants that are not so effective when it comes towards the vaccine. And Ed, are you fear-mongering? No, I'm not fear-mongering. I'm just pinpointing this one for one thing. Think about lockdown stocks, think about PPE, think about more off-hospital equipments. Those stocks might benefit the most out of it when you're looking into a stock perspective. Now a bit of charting going on. And if you'd like to see more materials like this, make sure to subscribe and notifications on. And if you want to join our Discord server, it's in the description below, it's free. Let's jump right into the charting part. Now, the one I'm going to go for is the SPY, NASDAQ. They usually go around almost the same place. And previously there was a different channel going around here and that kind of dipped, and now we're into this longer channel. And so currently we hit the bottom of the channel, we pierced it a couple of times, but we're still holding somewhat strongly on there. So currently the bottom of the channel on the SPY would be around 388. The top is a little bit higher, but there's currently a resistance, a strong resistance sitting at almost the $400 mark. Now that is an all-time high. And it looks like every time we're bouncing up, we're hitting an all-time high and then dropping back down. And it's kind of almost like a cyclical thing that we keep going on, right? And if I was to say, well, if we were to say see a massive dip, you're probably looking at a very strong support at the 369 level. Following there, you're looking at 353.63, and then perhaps another strong one at 333. Again, SPY and all these indicators don't have much of a resistance. The resistance is 395, which in fact we were there almost yesterday. Even though the market, a lot of these stocks, the value stocks, have been dropping hard, the SPY indicator has been doing so well. And so maybe we need to look a little bit into something like the QQQ, which is more of a reflection of the Nasdaq. And even then, you can start drawing this channel that is a little bit better fit here. And you're seeing we're still into the bottom channel. On the Nasdaq, we're testing this in the bottom channel. And the bottom has been hit today around 311.69. And you're seeing other levels of support downwards, going downwards somewhere, I would say, around the 300. And then below there, 289, 282, and we're hitting 273. When it comes in towards the resistance marks, you're looking at 321, 330, and going up to 338. Comes to the question to Ed, what do you think? I'm thinking that in terms of the stocks that I'm buying, I'm really starting to focus on the fundamentals, and I'm putting into consideration if the market was to crash tomorrow, literally overnight, will I be fine holding it over for the next 10 years, or will I just cash out? If I'm fine holding it forever and until retirement or whatever, worst case comes to worst, I'm fine having that money in there. And the money I'm keeping in here is money I'm fine losing. And so that has been my strategy, especially lately and into the next couple of months. A lot of the things that happened, for instance, the GME mania, and a lot of people start moving on towards options and NFTs. And these are money going out of the stock market and people realizing, or not realizing, being deceived that you can get rich easily or quick and within a couple of plays like GME, putting YOLOing all your portfolio. And that's definitely moving some money away from this kind of behavior from the stock market and more into a gambling. And that scares a little bit off smart money. What do you think about this? Make sure to mention down in the comments below. Share, subscribe, and like. Have a wonderful day.